Charles Ellis, in his classic investment book, Winning the Loser's Game, made a strong case for why investment management has evolved from a winner's game where active stock managers can outperform the market indices to a loser's game where most trail their designated market benchmarks. Decades ago, the vast majority of stock trades were made by amateur investors. Professional investors could gain an informational advantage over these amateurs by conducting research on the companies issuing stock. These professionals could determine which stocks were over or undervalued because the market was primarily comprised of investors who didn't conduct as much research. And so if you were a professional investor, a stock market is an auction market. So who was on the other side of the trade? If you had done your due diligence, you determined a stock was undervalued and then went out to buy it, typically the seller was an individual, not another institution. Over time, more and more trades were made by institutions, and as computing power increased and the cost of technology fell, professional investors got better and better at identifying mispriced securities. Ellis writes, as a group, professional money managers are so good that they make it nearly impossible for any one professional to outperform the market they together now dominate. And so it's smart people against very, very smart people. This high level of competition means very few active managers can outperform the market indices after fees. For example, a 2013 study by NerdWallet showed only 24% of active U.S.-based mutual funds outperformed their designated benchmark for the 10 years ending December 31st, 2013. The study showed index funds that seek to replicate the market outperformed actively managed funds by 0.8% annually. Likewise, a study by S&P Dow Indices found 86% of European-based actively managed funds investing in global, U.S., and emerging markets failed to beat their benchmarks for the 10 years ending December 31st, 2015. The disappointing performance has led more and more investors to pull money from actively managed funds and allocate it to exchange-traded funds, or ETFs, and index mutual funds that seek to replicate areas of the market rather than try to outperform them. In 2015, ETFs received $200 billion in new inflows, while actively managed funds suffered $124 billion in outflows, according to the research firm EPFR. This trend has continued in 2016.